You know that moment. It's 12:14 a.m. You're in bed. You should be asleep. But instead, you're scrolling real estate listings like you hate watching your own future. And what do you see? A 3-bedroom box with beige carpet, laminate countertops from 2003, a water heater that looks one hard winter away from a spiritual exit, and a description calling it a charming starter home. Price, $500,000. For a starter home. A starter home, like this is some normal first step into adulthood and not a financial hostage situation with a lawn. And if you've looked at those listings and thought, am I crazy? Am I behind? Am I just bad with money? Let me save you months of shame right now. It's not you, it's the math. That's the whole video. Not your discipline, not your ambition, not your mindset. The math is broken, and once you see it clearly, you can stop blaming yourself for failing a game that was built to make average people feel inadequate. The $500,000 starter home is a financial death trap. Let's start with the lie. The lie is that a $500,000 house is normal. The latest census data puts median U.S. household income at $83,730. So when people casually talk about a $500,000 starter home, what they're really describing is a house that costs about 6 times what the typical household makes in a year. That is not normal. That is not affordable. That is not a starter anything. That is a fantasy product being marketed as a rite of passage. And then people hit you with the old advice. Just put 20% down. Cool. On a $500,000 house, that's $100,000. Do you know what the Federal Reserve says the median family has in liquid savings? $8,000. So, America is out here telling households with $8,000 to somehow produce $100,000 just to get to the front door of a starter home. That's not advice. That's performance art. And this is where people start internalizing the wrong lesson. They think, I need to grind harder. I need to stop buying coffee. I need better habits. No, you need to stop accepting insane standards as if they're basic adulthood. Now let's do the part nobody wants to do, the monthly payment, because the housing industry loves to wave around the phrase building equity like it's holy water, while casually ignoring the monthly blood loss required to survive the deal. Let's say you buy that $500,000 starter home with 10% down. That means you're borrowing about $450,000. With a 30-year fixed rate around 6.49%, your principal and interest payment lands around $2,841 a month before you even start adding the rest of the nonsense. Now stack on real life. Property taxes, $500 a month. Homeowners insurance, $300 a month. Then there's PMI private mortgage insurance, which I lovingly call the poverty tax. Because if you're not rich enough to put 20% down, the system charges you extra every month for the privilege of not already being wealthy. That can easily run $200 to $400 a month. And then the part people pretend doesn't exist. Maintenance. Roofs fail. HVAC systems die. Water heaters explode on weekends because apparently appliances believe in dramatic timing. On a $500,000 house, even the low-end 1% maintenance rule is $5,000 a year, or about $417 a month. So let's total this up. Mortgage, $2,841. Taxes, $5. Insurance, $300. PMI, $309. Maintenance, $417. That gets you to roughly $4,367 per month. Not your utilities, not your internet, not your HOA, not furniture, not moving costs, just the baseline, $4,367 a month. That is not a mortgage. That is a financial stress simulator with beige carpet. Now here's where the story really falls apart. If housing should be about 28% of gross income, then to carry $4,367 a month, a household would need to make about $187,000 per year. Read that again. Not $100,000, not $120,000, not doing pretty well. $187,000 a year, and the median household is at about $84,000. So when the culture acts like a $500,000 starter home is some ordinary milestone, what it's really saying is, hey, average American family, why aren't you living like a top-tier household? That's the trap. The benchmark is detached from reality, but the shame still gets assigned to you. You feel behind because the target was set for a slice of households at the top, then marketed to everyone like it was middle class. That's not aspiration. That's manipulation. Let me introduce you to the Johnsons. The Johnsons make $160,000 a year. On paper, that sounds solid, even impressive. They buy the house anyway because everyone tells them it's what responsible adults do. The lender says they qualify. The agent says, you can always refinance later. Their friends congratulate them. Instagram tells them they made it, but here's their actual life. They're not thriving. They're bracing. Every car noise feels expensive. Every school fee is annoying. Every dentist appointment becomes a calendar-level event. Every holiday feels like bad timing. The dishwasher breaks. Stress. The insurance renews higher. Stress, kid needs braces. Stress, one income hiccup. Full panic. And the weird part is, From the outside, they look successful. Nice house, nice neighborhood, nice kitchen island. Inside, they're one unexpected expense away from disaster. That's what being house poor actually means. It means the house owns your margin. It means your emergency fund never quite recovers. It means your monthly cash flow is so tight that normal life feels like an attack. It means midnight anxiety. It means standing in a grocery store, checking your bank balance before buying food, while living in a house that the internet says proves you made it. That is not wealth. That is cortisol with a two-car garage. And this is where a lot of people get trapped by identity. Because once you buy the house, you don't just own a payment. You build an identity around surviving it. You become the person who says, well, this is just what adulthood costs. No, that's what a bad deal costs. So, who's the villain here? Honestly, it's not one person. It's a whole ecosystem of collective financial insanity. Banks and lenders don't ask, will this family feel peaceful? They ask, can this loan fit inside the allowable debt ratios? And here's the problem. The system often normalizes debt loads far above what creates a stable life. Some automated underwriting guidelines can allow total debt-to-income ratios as high as 50%. But approved is not the same thing as affordable. Approved means the spreadsheet didn't burst into flames. That's it. And then you've got agents incentivized to close deals, not protect your future peace. The industry language is full of pressure words. Stretch a little. Get in now. Marry the house. Date the rate. You'll grow into the payment. That is wild. Imagine using that logic anywhere else. Buy the yacht. You'll grow into the dock fees. It's absurd. But in housing, absurdity gets dressed up as maturity. We already live in a culture selling people automotive Stockholm syndrome, convincing them a brutal car payment is freedom. In some cases, it's just wealth destruction with cup holders. Housing can become the bigger, more socially approved version of the same trap. Now here's the part I actually care about. The point of this video is not to make you hopeless. It's to make you dangerous. Dangerous to the sales pitch. Dangerous to fake benchmarks. Dangerous to the idea that your life is only valid if you buy the house everyone told you to buy. Because once you understand the math, you get your power back. You realize the goal is not to look rich. The goal is to have margin. Margin is what lets you sleep. Margin is what lets you leave a bad job. Margin is what lets you survive layoffs. Margin is what lets you handle the ER visit, the transmission, the funeral flight, the surprise tax bill, the life stuff. Real wealth is freedom, not equity you can't access without selling, borrowing, or praying rates cooperate. Real wealth is not being trapped. So maybe the better identity is not homeowner at all costs. Maybe the better identity is, I'm a saver. I'm a buyer only when the deal is good. I'm a person with options. I refuse to become a prisoner in my own house. That is a grown-up identity. That is strength. So let me give you permission that almost nobody gives. It is okay to keep renting. It is okay to say, I'm not paying $500,000 for a glorified drywall cube with 2003 laminate and a payment that eats my life. It is okay to look at smaller markets. It is okay to move later than your friends. It is okay to prioritize a $10,000 breathing room fund over a down payment that wipes you out. It is okay to choose peace over appearances. And it is definitely okay to stop playing a rigged game just because everyone around you is calling it normal. Because normal, right now, is broke. Normal is stressed. Normal is over. Normal is smiling and listing photos and sweating in private. You do not need to be normal. You need to be free. If this hit home, drop your own brutal math story in the comments. What was the listing price? What was the monthly payment? What did the spreadsheet actually tell you once you stopped lying to yourself? I want to hear the real numbers. And if you want more content that helps you escape the hamster wheel of being average, the debt traps, the fake milestones, the money lies people repeat because they're scared to think for themselves, subscribe. Because the goal here is not to impress people. The goal is to build a life with options. And that starts when you stop confusing expensive with smart.